Today we're covering financial ratios and their analysis for the Series 65 exam. You will be tested on your ability to not only calculate, but more importantly, interpret these ratios to assess a company's financial health. Let's start with liquidity ratios, which measure a company's ability to meet its short-term obligations. The current ratio is calculated by dividing current assets by current liabilities. For instance, if a company has $100,000 in current assets and $50,000 in current liabilities, its current ratio is 2-to-1. This means it has $2 of current assets for every $1 of current liabilities. An exam trap here is to confuse current assets with total assets. Always focus on assets expected to be converted to cash within 1 year. A stricter measure of liquidity is the quick ratio, also known as the acid test ratio. The formula is current assets minus inventory, all divided by current liabilities. The exam loves to test this distinction. Inventory is excluded because it might not be easily or quickly converted to cash. So, if that same company had $30,000 of inventory, its quick assets would be $70,000 and the quick ratio would be 1.4-to-1. Next, we have the debt-to-equity ratio, which is a key measure of a company's financial leverage. It's calculated by dividing total debt by shareholder equity. A high ratio indicates that a company is using a significant amount of debt to finance its operations, which increases its risk profile. The Series 65 will expect you to understand that a highly leveraged company is more vulnerable to economic downturns. Now let's move to valuation. The price-to-earnings, or PE ratio, is a fundamental tool calculated as the market price per share divided by the earnings per share. A high PE might suggest that investors expect higher future earnings growth, but the exam will want you to know it's most useful when comparing companies within the same industry. A common point of confusion is what the PE ratio really tells you. It's a measure of what the market is willing to pay today for $1 of current earnings. To get a more dynamic picture, we use the PEG ratio, which is the PE ratio divided by the annual earnings per share growth rate. This is a favorite exam topic because it incorporates growth into the valuation. A stock with a PE of 30 and a growth rate of 15% has a PEG of 2. Another stock with a PE of 20 and a growth rate of 25% has a PEG of 0.8. The exam will test your ability to see that the second stock may be a better value, despite its lower PE, because you're paying less for its growth. Finally, return on equity, or ROE, measures profitability. It's calculated as net income divided by shareholder equity. ROE shows how effectively a company is using the money invested by its shareholders to generate profits. A consistently high ROE is a sign of strong management. For a mental shortcut, remember this phrase: current is comfortable, but quick is crucial. This helps you recall that the current ratio gives a general sense of liquidity, but the quick ratio is a more critical, stringent test for immediate cash needs because it removes inventory. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.